Welcome back, everyone. So, we are on the 18th episode here of The Growth Factor. I've got business partner and brother Boone on with us again, as well as our managing director, Brian Robb, joining us. We're going to dive into really what inflation has done to the market and the economy over the last 3 years. We're going to get into how we calculate ROI and what that looks like, what the expected ROIs are when we invest in real estate and the deals that we're looking at, how that compares to market equities and things like that. And we'll do a few comparisons between real estate and where the S&P 500 is today. But more importantly, really from a high level, if you're sitting on $250,000 liquid right now, where is the right place to put that from an investment perspective so that you can optimize your growth, so that maybe you can find some cash flow if that's what you're looking for, so that you can have some tax advantages to keep more of your hard-earned dollars and hard-working dollars in your pocket, and really invest in a opportunity at a discount. So you're starting with some equity up front. So what does that look like for those of you that are sitting on, 100, 250, 500,000, or maybe $1 million? I've talked with a couple of clients over the last couple of weeks that, have $500,000 to $1 million liquid right now that they're looking to allocate. In fact, I talked to an investor yesterday that is liquidating $4.5 million in the next couple of weeks and looking for a place to allocate that. And so obviously at different levels, different amounts, you're going to look at it with a little bit different of approach. But that being said, if you're sitting on some liquidity right now, where is the best place to be focusing on? So Boone, I'm going to turn it over to you, open the mic up to you. You start asking some questions, firing away, and we'll have fun with this.
Yep. So we actually had some question comes in from fans this week that we're going to ask. So we're going to dive into those. I know you touched a little bit about inflation, a little bit about the market. I think that ties in well to with what's happening in the economy right now. We're going into what probably is tomorrow the last meeting as for Jerome Powell as the Fed chair. Where does the market go from here? And how has he combated the market, and how is Mr. Walsh going to do it on the backside coming in as the new Fed chair? So we're going to start off with a question from a fan that wrote in, said they've got $250,000 of cash right now, and with inflation still biting a little bit, with what's going on in over in Iran. Getting some inflation in the oil and gas markets because of the blockades on the Strait of Hormuz. If I've got $250,000 right now, where should I invest it for passive income and for growth? Should it be, should I expect the same thing from one investment? Should I be multiplying that over across multiple investments? What should I do?
So I'll jump out and give an answer there a little bit. And then, Brian, I want to hear your perspective, really. We've talked about this on a couple of episodes in the past, and really what starts triggering investors. And oftentimes, so much is the case that when the equities market starts to climb and post all-time highs, you see all of that frenzy, and I'll call it a feeding frenzy on the news. Whatever news channel it is, whatever business channel it is, all you see is highs, highs, highs. And so that starts triggering investors, and they start allocating capital into the equities market, and now you're buying at a high. So if I'm sitting on $250,000 liquid right now, I'm looking for a physical, tangible asset, something that I can feel and touch. And more importantly, we've got huge opportunities in real estate right now because of interest rates. Interest rates have been so high for so long. You've got investors that acquired assets when interest rates were low. And we've seen a 3-year inflation period with interest rates that just so happens to cycle with what many of the bridge loans that were made 3 years ago happens to term out at. And so we've got billions of dollars of bridge loans maturing or have already matured, and lenders are wanting those off their books. For operators that have liquidity and or have the capacity to negotiate with lenders, it creates opportunities. For those that don't have liquidity, they're walking away from assets, and banks are stepping in looking to offload those assets at less than loan amount. And so this creates a huge opportunity in the real estate sector to jump in and acquire assets in a distressed market with significant discounts, because you've got a lender wanting to get a bad loan, bad portfolio off their books. And so that creates huge opportunity where, that's where you really want to take advantage. And so if you're sitting on some liquidity right now, real estate is the prime play, because we're sitting at the bottom of the trough at the, really ideal scenario where we've got distress in the market. Assets are still, we still have well under supply as it correlates to the demand of affordable housing. And yet we've got lenders that are creating an opportunity for investors that are liquid right now. So if you're sitting on $250,000, real estate creates a huge opportunity, just because you're buying low in a distressed market, and you're going to have the opportunity to ride that investment up. And also, when you buy low with low leverage, it creates more opportunity for cash flow. And so this is the opportune time to really take advantage of what I call those four keys to wealth as it pertains to an investment, where you're going to buy at a discount, you're buying in equity, you're going to see appreciation as the real estate market resets and as the debt markets reset. When you're buying at such a discount, you're going to see cash flow, and then obviously you have that tax advantage to play along with it. So, Brian, I'm curious your thoughts.
Yeah, thank you, Ty. I think when it comes to overall investing, it's really easy for us to get in the habit of being myopic about looking at what's happened recently and kind of that last shiny lure that's right in front of us. And the reality is the S&P over the last 10, even longer years has had a really good run. I think people forget about some of the downturns that we've had in the not too recent past. In 2018, we had a downturn of a little over 6%. In 2022, there was a downturn of about 20%. We've seen a lot of volatility as it relates to the broader equity markets. This year, a lot of that's driven by some of the things that we're seeing overseas, and macroeconomic policies. And so the market, while earlier, a month or two ago, was at record highs, we're down to about, I think, a 4% positive year to date. And so it's kind of an investing 101 tenet that you want to buy low and sell high. And so we do have kind of this perfect storm where the equity markets have historically been at record highs. We are starting to see those signs of corrections. And to your point earlier, we've got a number of different factors that are creating great buying opportunities for real estate. I would touch on one other thing, and that is inflation. And that's something that a lot of us may not think enough about when it comes to traditional investing. And if you had a traditional public market investment, and let's say that returned 10%, decent return, it's easy for us to forget that you have to look at that in terms of your actual nominal return minus inflation. And inflation historically, let's just say, is going to average 2, maybe 3%. It's been much higher in recent years. We've seen that drive interest rates up, obviously. So when you factor in, say, a traditional 10% return, and you factor in inflation, especially in the last couple of years, you're looking at maybe a 6 or a 7% return. But as we all know, you also have to factor in taxes. And taxes are going to reduce that return even greater. Then you have to factor in something that we've talked about before, and that is the behavioral aspect of investing.
Yeah.
And it is very easy when markets go up to get excited and to buy in, and when markets go down to get discouraged and to buy and to sell out of those. And so your actual returns, when you factor in inflation, taxes, and just normal human activity, actually nears about 0%. And the real benefit of real estate is that you do get to lock in equity at a discount, like we're seeing today with some of these significant loan discounts. And I would say it's a focus on not just income, but also income and growth, which I know we'll talk a little bit more about.
Yeah, that's good. Well, we actually have a live question right now from the chat box. So from Myron A says, Ty, this is for you. How do interest rates change real estate returns? Why do rate cycles create distressed opportunities?
Uh, well, I mean, when you use leverage on an asset, so let's say, you can leverage and interest can do good and bad. And so when you've got a market like anything that was not the last 3 years, where you've got single digit interest rates, really sub 5% interest rates, then your cost of debt is far cheaper than the cost of private capital. And so let's say that you're running a equity stack that you're giving a 10% preferred rate of return, and you're then splitting profits 80/20 over and above that. Okay, fantastic. Well, if you've got debt that is 5% and you're buying an asset that is going to produce with 60% leverage, that's at 5% debt versus 80% leverage at 5% debt, you're going to get a lower cost of capital on that extra 20%, going from 60 to 80% leverage. Because now instead of paying the 10% pref and splitting 80/20 on all the profits, you're using cheaper cost of capital, i.e. 5%, all the way up to 80% of the capital stack. And so now you can use less expensive money to generate a higher overall return. However, in the flip circumstance, when you've got maybe a variable interest rate loan or you've got high interest, then you want to use less leverage because that interest is going to cut into more of your overall profits. It's going to cut into more cash flow because you're going to use more cash flow to cover your debt service, and or if you're buying an asset assuming negative cash flow after debt service, which a lot of California investors do, or New York investors, where they know that the value of that dirt is going to appreciate faster than the cost of their debt, but maybe the asset doesn't cash flow enough to cover the debt. Well, then they'll raise enough money to cover the negative debt service long enough for them to hold the property long enough and then turn around and sell. So, if you're using up more of your cash flow on debt service, that's obviously going to eat into your returns to some extent. And so it's, a levered IRR versus a non-levered IRR. The levered IRR is always going to be stronger. That does not mean it's less risky though. A levered return where you're using cheap cost of capital with leverage comes with pros because you can generate higher returns, but the cons are it can also negatively impact your investment when interest rates get too high on like a variable interest rate loan.
Yeah, Brian, you got any thoughts there?
Yeah, I would just say, because we've had this question come up quite a bit recently, and that is, how do operators deploy rate caps in the environment that we've been in over the past couple of years? And, look, everyone can be a Monday morning quarterback and say, hey, with rising rates, it did make sense to deploy probably more aggressive rate cap structures than were done previously. And anyone could probably say that. I think it's important to look at real estate cycles over longer time periods versus just the past couple of years. And the reality is, if you work with an operator or you're an operator who exclusively deploys rate caps, I look at that as analogous to a healthy 25-year-old purchasing life insurance. It may work, and if you need it, it works great. But the chance of needing it, again, over longer cycles, really can be a drag on your overall returns. And so, hindsight is always 2020, but you have to look at this in terms of 5 to 10 or even longer cycles. And generally working with operators that deploy a mixture of assumable rate notes, some variable rates, and some variable rates that have some rate caps can actually generate greater wealth and greater returns over longer time periods than exclusively deploying rate caps in environments like we've seen in the past couple of years.
So, Brian, you talked about rate caps there. Obviously, that's a bit of protection against interest rate movements. There's a few different things you can utilize between a rate cap, prepaying interest reserves. Kind of give us a high level explanation to the public of what a rate cap is.
Yeah, so in general, if you lever an asset, it's really no different than if you're an individual investor and you buy a variable rate note on a home. That note may come with a certain percentage. Let's say it starts at 6%, and then after a number of years, typically after 3 years, the bank reserves the right to adjust that up, and that could go up a certain amount. Maybe it goes up 3%, so now you're looking at a 9% rate. Maybe it goes up more than that after another couple of years. So essentially, you are paying for insurance to ensure that that rate doesn't increase beyond a certain level. So you can protect your overall net operating income. And in my example, if you started with a 6% rate and you decided to deploy a rate cap to ensure that it didn't go above, let's say, 8%, that can protect your net operating income should we see a rise in interest rates. Now, what if interest rates don't go up? Well, you've essentially paid the bank for that insurance and you're not using it. So that money is not free money. That money is essentially a drag on
I've
your
got an
overall return.
example. Yeah, I've got an example on that. I mean, we bought on a loan that we initiated the loan at 3.1% interest, I believe. We paid $250,000 for a rate cap, and that rate cap kicked in at 6%. Well, interest rates went well above 6%, and for well more than 2 or 3 years, that rate cap in essence paid us over $2 million, I think 2.4 or $2.6 million, and it cost us $250,000. So huge opportunity there. On the flip side, we also bought a rate cap at $1 million that never exceeded the interest rate that we set the rate cap at, and so it never paid out anything. So that one cost us $1 million, and so you can go both ways with that. But I think one other thing that really interest rates affect in real estate markets and their returns is refinance risk. Most operators are buying a property with the intent of executing some business strategy that's going to increase NOI. And in order to do that, typically you're going to have either distress on the asset or you're going to force some sort of vacancy for a while to turn units. All the while, your property is not going to be stabilized. So typically, if you're going to have a non-stabilized property during a business plan, you're not going to get traditional lending. It's going to be bridge financing. And your expectation is to get out of that bridge financing with a permanent refinance once you stabilize. Well, if interest rates go up, and in circumstances like over the last 3 years, we saw interest rates more than double and in some cases triple. And when you go to refinance, the amount of capital that you're getting out on the new loan is predicated around what your NOI is and how much that NOI can cover the debt service. Well, if the new loan that's being refinanced is at 8%, and your original loan, you originally underwrote it was at 3%, and maybe you underwrote to go as high as 6%, but now you're at 8%, that additional 2% applied to the NOI is going to affect your proceeds significantly, and you're going to end up not being able to refinance enough to take out the original loan. And that's what puts operators in scenarios like what I'm talking about that we have now, where there's huge opportunity in real estate, because now all of a sudden they've got a property that they're in at 21 million dollars. They've got a 15, $16 million loan, and they're only going to be able to refinance $12 million. Well, if they don't have $4 million liquid, they're going to be in a heap of trouble. And that's what we've seen tons of now. And so the bank ends up stepping in and taking the asset, and they've got a $14 million loan that they're happy to walk away with now at 10, 11, or $12 million because they've had to take it back. And so now an operator like ourselves with liquidity can step in and negotiate that discounted payoff with a lender.
Yeah. So, Brian, I want to come back to you because you have spent time. We've talked about this before, both in the public and the private markets. Um, Setting in the type of market cycle that we're in, you have different options between private equity, stocks, bonds, mutual funds, precious metals, crypto, all doing a lot of different things. In the market cycle or market volatility that we're in today, where does true growth happen?
You have to look at it in terms of not just cash flow, but you have to focus on cash flow, value appreciation, equity growth, and then especially in what we've seen over the last couple of years is you have to look at asset classes that combat both inflation and taxes. And so it's rare you're going to find that in any single asset class. You don't find it in precious metals. You don't find it in traditional public market investing. You don't find it in bonds. You don't find it in those types of securities. You can find it in real estate. So real estate really is unique, not only because of the market cycle that we're in, where we've seen historic high interest rates, which has created a lot of value creation and value opportunities in the form of discounted loan payoffs. But the flip side of that is you also have historically had record high equity markets over the past couple of years. So you've really got this perfect storm of record high equity markets, which we've already seen some corrections occurring there. You've got record values being provided in the real estate market, and then you tie that in and build that in with the tax benefits and the inflation combating benefits that you receive in real estate with cash flow. All of those together really create kind of this perfect storm that you don't really see in any other type of asset class currently in this market.
Ty, anything to add there?
Yeah, no, I mean, I think, when we have market cycles like what we're seeing right now, you're really seeing that inverse relationship with a physical asset versus a stock, bond, or mutual fund. And I think that's the whole goal around diversification. And we've talked about it before. Diversification is not five different stocks in the stock market. It's different asset classes, and really focusing on asset classes that are counter correlated to the equities market, so that when you have a market shift in any type of asset, you're gonna have some. You may have, like we have distressed real estate right now. Well, it creates a buying opportunity, but if you bought 3 years ago, it creates a waiting opportunity, and vice versa with the equities market. We're setting at all-time highs. Well, it's a selling market, so you've been holding. It's time to step out and reallocate, because we're going to end up having a swap of that, where the equities market resets and real estate starts to pick back up again. And so we're seeing that right now play out as we speak.
Ty, I would tie in a little bit more on the diversification, because if you are a public markets investor, and we've talked about this in prior episodes, you tend to look at diversification in what's called the style box. And the style box for public markets is a simple way of saying you've got large cap companies, mid cap companies, small cap companies, and then those can vary between value, blended, and then growth oriented. The reality is all of those are still public equities, and all of those are still stock market type investments, whether it's a large company like NVIDIA or whether it's a small publicly traded company that we see in some of the more local markets. But all of those are really another interpretation of a public market equity. And you're right, true diversification really takes out one of the asset classes that is talked about more and more, especially among private family offices and high net worth investors, and that is real estate. And so it's something you're starting to see more and more in, I'll say, traditional style boxes, adding real estate as kind of that asset class. That's a much bigger focus moving forward.
Yeah. So, Brian, you make a good point there. When you're diversifying your investments, I think you look for one thing you look to different asset classes for what they produce. Obviously, real estate, that is the one asset class that produces all four of cash flow, of appreciation, of the opportunity for buying equity, and the opportunity to have, massive tax advantages. There are assets we buy within our fund that some of them produce a significant amount of cash flow, but they're not in high appreciating areas. Some we buy are in high appreciating areas, but there is tighter spreads on cash flow. And so going into that, Ty, I want to come to you on what does cash flow mean to you? Does cash flow and is cash flow the same thing as distributions? We've seen groups like BlackRock who have not only turned off distribution, they've turned off withdrawals from their fund. So walk me through. Is chasing a monthly distribution, does that hurt a long-term return? And what does that mean to my overall investment?
Well, I don't think it doesn't hurt it. Look, cash flow is great. Cash flow is a risk reduction. So when you're buying cash flow, you're naturally going to reduce the risk of your investment to some extent. That being said, you're probably giving up something in the long run. And so, when you're buying a piece of property right now, let's say you're spending $10 million on a piece of property and you're going to generate $700,000 in net positive cash flow, or you're buying that on a 7 cap. Well, there's likely something that you're giving up for that. The likelihood of growth may be smaller. You're giving up something for that amount of cash flow, or it's going to be an extremely hard property or hard asset to manage. And on the flip side, a property that may not have significant cash flow early on, but it needs a little bit of turnover and a little bit of work in order to build up to that cash flow, may have higher overall upside value on the back end. And so, I think just chasing cash flow, yeah, we could go out and buy properties today that have a little bit of cash flow with them, and investors are looking at, 3-4% cash flow right now. And if they get 3 or 4% cash flow, they have a good that's a good investment. And then you add the growth on top of that, where you're hitting an 18-20% annualized rate of return, then you've got a really good investment. Well, we could go out and buy cash flow all day every day, but you're going to give up some of those bigger upside opportunities. Whereas on the flip side, we're looking at a couple of deals right now, as you know, that we've got contracted that are not going to cash flow for 3 to 6 months as we step in and do unit turns. But their overall upside potential is 26, 28, 30% annualized rates of returns. Because we're moving, one of them specifically is a conversion from workforce housing to student housing in a market where there's nearly 1,000 kids living in short-term hotel type accommodations. And so there's a huge opportunity there, and the value add, we're going to go in and spend about $8,500 a unit, and that's going to add about $300 a month in income, or $3,600 a year. So that's a north of 30% ROI on that unit turn spend alone. And it's going to create huge upside opportunity on the back end, and we're going to give up a little bit of cash flow early on the front side. So I think having short-term views at, well, I want cash flow from day one, you're not looking at the overall picture as a wealth building mechanism. And the thing with real estate is it's not a get rich quick scenario. You're not going to, it's not going to have the NVIDIA effect that we saw, what was that, maybe 5 years ago or so when somebody that got in Boone, I think you were a part of that opportunity when there was massive growth there. And overnight, your stock portfolio jumped up by 20, 25, 30%. You're not going to see that in real estate. The thing with real estate is it's not get rich quick, but it is get rich for sure. When you put money into it, you play the patient long game, it is going to build wealth. There's a reason there's 2,000 new millionaires every year, and the majority of those are built through real estate. There's a reason that a majority of the high net worth, the wealthy individuals in America have their money in real estate. It's get wealthy for sure, but it's a long, patient game.
So you mentioned several acronyms there, and obviously, one of the best investors of all time, Warren Buffett. He does not play the get rich quick scheme. Now, obviously, he's in businesses mostly. He does do manufactured homes. He does do some real estate, but he plays pay a fair price for a fair asset, get a fair return, and be able to predict growth. You talked about internal rate of return, average annual return, annualized rate of return, return on investment, ROI, IRR, AAR, ARR, all those different things. Brian, I want to come to you. How does a sophisticated investor look at a investment and measure success on it? Beyond just looking at cash on cash.
Yeah, I'd say there's a couple of metrics that you have to look at. I mean, your basic return on investment, if you kind of just really want to dumb it down and simplify it, is your net operating income over your total investment. And so you can look at it from that standpoint, which is probably an accurate way to look at it. You can also look at it on cash on cash. I mean, that's kind of a return on your out-of-pocket cash in a specific investment versus looking at the total property price. And if you think about it, it's really just your annual cash flow over the total amount invested. So I would say you want to look at two things. I wouldn't exclusively look at cash on cash. It's really beyond that and looking at overall return on investment, which you have to look at kind of holistically as far as your overall net operating income based on your overall investment.
Yeah, there's a number of, I think, levels that you can go into. Brian made a good point that you don't want to just look at one. I look at a number of them. And one thing that I learned when I was working at KPMG, and I focused on private equity, one thing that I learned from the Bass family, and that I learned from the executives at TPG, at a number of the big private equity firms, was equity multiple. How quickly can I turn my money, and how much can I turn it by? And it was always kind of, the going factor is 2 times in 5 years. So I invest $500,000. In 5 years, I want that to be worth $1 million. Now, some of that comes in the form of cash flow. Some of that comes in the form of growth. Some of that comes in the form of, making money in the buy, so buying at a discount. And then you've got the tax equation that's built into that. How much of your overall earnings, when you're taking a comparison between a private equity deal that operates with net operating losses for the 4 or 5 years that you hold the deal, and then you have a huge upside exit, or you've got a real estate deal that maybe has a little bit of cash flow along the way and then a big upside exit, but you're going to get a tax advantage on both of those deals versus the equities market, and maybe you double your money on paper in 5 years with all 3 scenarios, but tax affected, the equities market dips down and it's a 1.8x multiple, whereas the real estate hits at a 2.2 or a 2.3 because you can take those tax losses and utilize them towards another piece of real estate or something like that. And so you've got to look at all that. And then, as I mentioned, IRR, IRR, or internal rate of return, really what that is your average annual return with a time value of money component tied to it. So I invest $100,000 today. So that's a negative outbound. It's going 100,000 out. and I get zero cash flow in year one, I get a little bit of cash flow in year two and a little bit more in year three, and I sell in year four and I get all of it. Okay, and let's say your average annual return came out to be 12%. Well, the IRR is probably going to be about 11% because you got a majority of that at the end. And so you're not taking your total income or your total growth and dividing it by 4 years. You're doing that, but then you're allocating the majority of that growth came in the fourth year. Whereas on a flip scenario, let's say you acquired it, 100,000 went out the door, nothing in year one, a little bit in year two, and you refinanced in year three, then a little bit, and so you got a big equity check out, and then a little bit in year four, and then you sold in year five and got another big check. That scenario, your IRR is probably going to outpace your average annual return because you got two big checks back to you, and so the time value of money gives you a booster there. And so it's good to understand your average annual return. What's your ROI? What did your money do on a yearly basis, looking at the grand scheme of the investment? But then also understanding that if you had to give up some in the front end to get that on the back end, you're then able to look at the risk for that investment. You know, how much am I giving up in cash flow to get a bigger upside on the back end, or how much am I getting in cash flow to give up a smaller on the back end and my IRR is lower?
We're going to take that right into one more acronym, which is a DPO. This is not on the return side. This is more on the purchase side. So, Todd, walk us through what is a DPO and why is it one of the biggest wealth drivers in real estate right now?
Yeah, so a DPO, it's a huge term right now, and we are exercising a number of those for opportunities right now. But it's a discounted payoff, and so it's when you get to step in and you start negotiating with a bank instead of the owner or seller of an asset. And maybe for Brian, you can probably talk about this as well. For simplicity purposes, it's almost like a short sell in owner-occupied houses. You always hear about, 08, 09, we had the subprime crisis and you had all these foreclosures. Well, before a property goes to a foreclosure, the lender has already stepped in and moved that asset from a performing loan to a non-performing loan. Maybe the occupant has not paid their payment in 2, 3, 4, depending on the state, 6, 8, 10 months. And so now all of a sudden you've got a lender that is motivated to sell that loan. And when they sell the loan, the asset's going to go with it. Or they may just sell the asset to get rid of the loan altogether, depending on what the buyer that they're looking at is negotiating. And in those circumstances, typically the bank takes what they call their REO schedule and they'll go to market with it. They'll work with their investors that, Boone, this is how you and I got started. Being my background in private equity, I had relationships with a number of groups that bought banks. And when they would buy a bank, they would bring us their REO schedule and say, hey, these are the non-performing assets that when we acquire this bank, we're discounting the purchase for these. We want to dump these day one. And all of a sudden, we've got a list of properties that we can step in and buy. Well, those are pre-foreclosures. Bank hadn't foreclosed and stepped in and taken the property to an auction at the courthouse steps. They are negotiating with possible buyers at that point for a discount. And let's say, so you move that into the commercial aspect. And I talked about this a while ago. Let's say you've got an owner that bought a property for, $18 million. They put $2 million in it. They're all in it at $20 million plus closing costs, maybe almost $21 million bucks. And they got a $15 million loan. Maybe they over leveraged a little bit because they were getting really cheap debt at the time, low interest rate. They got a $15 million loan. And they brought $7 million of their own capital into the deal. And all of a sudden, their cash flow is not covering the cost of debt, or it's at the end of the original term and they have to either refinance or sell, or lender is stepping in and exercising on lender required repairs. an operator has not had enough cash to manage those repairs. And so now the lender is putting pressure on the operator and working on potentially taking the asset back. Well, with real estate, specifically large commercial sized real estate, operators tend to fold more quickly and they just walk away from it. They can't deal with that headache. And so then the lenders come to operators like ourselves and say, hey, we've got this asset. It's worth today 17, 18, 19 million dollars. Operator has 20, 21 million dollars in it. We've got a $15 million loan. It's already been moved to our REO schedule. It's bad debt. We've written it down, and they're willing to take $12.5 million for that $15 million loan. So now we're able to step in and not only buy well below replacement value, but we're buying below the cost. We're buying below debt at that point. Creates a huge upside opportunity there for that, what is called a discounted payoff, or DPO. And so that DPO becomes free equity to us.
Well, and it really resets the market. You're resetting capital stacks, you're resetting basis, and resetting the purchase market. And so yeah, I think it's
to that point. It's a tool that Donald Trump used in the late 80s and 90s. And there's we've done this on some of our own assets as well. So we're looking at assets from other operators, but we used it as a tool. We took a couple of assets into a Chapter 11, tied it up so that it forced a bank to come to the table and negotiate, because we can then argue you're writing this debt down. If you want to take this property, you're going to sell it for less than the debt that you have. So let's renegotiate our debt that we have for more than what you would be selling it for if you took this property and went to the open market. So go back to my scenario where we've got a $20 million asset with a $15 million loan on it that the lender is going to go to market and they may sell it at $12 million. Well, we'll step in and we'll negotiate down to $13 million. So we get $2 million of free equity. We reset the basis on the property. We reset the tax calculator as well. And we've reset market now, and it makes it easier for us to go negotiate with other banks at that point because our bank has already taken a discount.
But so you mentioned, one of the things we're doing right now is obviously we've taken some assets into bankruptcy to force negotiations with the bank. So many people hear that word, put negative connotation to it when it's just another tool if you're an effective business person, it's your tool belt. It's, I was talking to a judge one time, and I used that word, and he got all, oh, you've done bankruptcies before, and I was like, well, yeah, it's no different than you saying the word judgment or something like that. It's terminology they hear every day. It's terminology we hear every day, and a tool that we know how to utilize. So I think that's an important thing.
Yeah, I mean, I think there's a perfect example. We was talking with one of our investors in basically an equity group that they specialize in taking assets of their own into bankruptcy and or stepping in and partnering with groups that are taking an asset into bankruptcy. Because when you do that, I've read all of the Trump books. I've read, I don't know how many real estate books on utilizing a Chapter 11 bankruptcy as a benefit to what you're trying to do. And so, not every scenario works out that way. And it also costs money to go into bankruptcy. You've got to have some liquidity to go into bankruptcy. People think, well, I don't have any money, I can just throw it into bankruptcy. No, it doesn't work that way. First of all, you got to pay your attorneys. You've also got to pay the lender's attorneys during that time. Like you agree from day one, you are paying for the lender's attorneys from day one. So there's $250,000 out the door immediately for both sides of attorneys. Then the court charges for bankruptcy. And you're not just going to walk out of bankruptcy not owing anything. You're going to have to pay to keep the asset in bankruptcy. You're going to have to keep the property up during bankruptcy. And then you're going to have a negotiated settlement coming out of bankruptcy where you're going to have to pay that lender off. Maybe you had a $15 million loan and you're only paying $12 million. New lender coming in is not going to give you $12 million. It's going to be $8-9 million. You're still going to have liquidity. And so it's a tool to buy you free equity, but you've got to have the capital to do it. And so it becomes a very, very, very useful tool to, like you said, reset that capital stack and buy some free equity.
Yeah. Well, hey, we've got through a lot of questions tonight. We are about out of time. I don't know if either one of you had any final thoughts you wanted to go over.
Brian, I want to hear your points, or I want to hear some from you on that. That last question on DPOs utilizing creative solutions to create opportunities in distressed market cycles. What are some of the things that you've seen utilized, and being a part of our team now for not quite a year yet, but I don't think how long has it been?
Just over a year.
Just over a year.
Right.
Fantastic. So being a part of our team for just over a year, how you and we got another marketing director as well that's just over a year. So how does how do the tools that we've utilized kind of play into what you've seen?
Yeah, I think it goes back to an operator having the wherewithal and the creativity to negotiate these types of solutions that essentially create wealth and create equity for our investors. And there's a couple of ways to look at it. You can do the quote unquote easy button, which candidly, you as an investor, if you're interested in dipping your toes in real estate, the easy button is probably looking at one of the big private equity REITs. That you can go online. You can probably move money from your existing brokerage account into it very simply. And, in your mind, you're taking advantage of the real estate market. But as a huge, organization that's managing not just billions, but in some cases, 50 billion, 60, $70 billion real estate, we talk about the efficiency factor. And when you are managing those types of assets and real estate, by definition, you are only going to be able to focus on efficient assets, meaning they're very efficiently priced in the marketplace. So think of the big office building in Manhattan, or the big office building in Houston. Those are going to be kind of the types of properties that are on your radar. Where working with a group like us, like Lasater Capital, you can uncover those inefficient markets. And especially having the types of relationships that we have with lenders, we can come up with creative solutions like these DPOs, because it's not just knowing the tactics and the tools out there, it's having the relationships and having the right relationships with the right lenders that enable you to pull the right triggers to take advantage of these types of things. And so, Ty, we hear you say this all the time, and it's not just focusing on operators that have been there during the good times, but it's focusing on ones that have really focused through some of these really, really difficult market cycles. And if you can manage effectively through these market cycles and uncover these opportunities, that's really what it's all about, is looking at some of the challenges the entire industry has faced and then creating opportunities throughout that cycle through tools like these DPOs that we are able to utilize with some of the fantastic relationships we have with lenders. That's just one tool in the toolbox, but I think that's something that's unique. And again, focusing with operators that are able to uncover some of those inefficiencies and really take advantage of the relationships that we have in these local markets.
Brian, I think you brought up a good point with, you said solutions. And I had conversations with probably 5 of our investors over the last week or two that the same conversation, the same topic, same theme came up. And one of the conversations, and this was with a range of our clients. I had a conversation with somebody that has, I think, $250,000 with us. And I had a very similar conversation with somebody that has $4 million with us. Somebody that was a retiree, somebody that was an entrepreneur, somebody that was a doctor in the medical profession. And that theme was, they didn't partner with us, and our 750 plus investors did not partner with us to have one pathway forward. They chose to not be an active real estate investor, be a passive real estate investor, to get those really 4 keys as it pertains to investing and building wealth that I talk about. And that's for us with experience to come up with solutions when problems face our pathway in front of us. And so, that conversation, what I was saying with them and talking with them about was, you partnered with us to have multiple solutions. When a problem steps up, how are we going to address it first of all? What's the second option? What's the third option? What's the fourth option? And to keep coming with solutions. And so when you work with an operation that's our size, that has, under $1 billion, just under $1 billion in AUM, then it comes with relationships. It comes with some flexibility and the ability to, implement a strategy, shift and change from that strategy, and come up with creative solutions to move forward. Whereas, when you're operating with one of the huge hedge funds that has $50 billion in capital that they've got to deploy, they're deploying that into some places that's not generating a return at all times. And just because they have the access to so much capital, you never truly see the impact of the losses that they have on some of the investments that they make. But they've got to allocate that capital. And so, they may have $50 billion in allocations that they got to make, and they go buy a $250 million asset that ends up generating a net loss for them, and you never notice it because of the amount of capital that they have in that fund until it's time to sell out that fund. And all of a sudden, not all the investors find themselves in a positive scenario. And so, I think that's where flexibility comes, and really, as you said, solutions. And that's kind of our focus around solutions is, what is option number 2, 3, and 4 whenever option number 1 doesn't work the way that we planned for it to?
Yeah. Well, it is it's the top of the hour. It is time to say goodbye this week. As always, stay smart, stay sharp, invest in growth. We'll see you next week on the Growth Factor. Have a good week, everybody.
Absolutely. Everybody have a great week. And like we took a live question this week, if you have questions, shoot us in questions, before the podcast or during the podcast. Would love to answer your questions and get anything answered that you're looking for. With that being said, we'll see you on episode 19 of The Growth Factor.